Hi, good evening, everyone. Welcome to Talk Stocks with James series. Today, I will share should investors be pumped up about Alibaba six-way business split. My name is James, market strategist at uSMART Securities. And please be reminded that we are conducting this webinar every alternate Thursday. Please tune in on 27 April as well for the next one. We have also recently conducted two webinars in partnership with SGX for the Singapore Trading Festival, and we have uploaded the video recordings to our YouTube channel, Talk Stocks with James. So if you are interested, please visit our channel on YouTube and check them out. And sorry, is my mic off? Testing 1, 2, 3, testing. Yeah, I think it should be all right? Everyone should be able to hear me. So let me begin with some disclaimer first. Today's presentation is for general education and sharing purpose only and does not constitute to any form of advice to buy or to sell. Past performance is not indicative of future performance. And recently, there has been a lot of buzz surrounding Alibaba, especially after the business split. And I often receive many questions about it. Therefore, I believe it's time to finally discuss Alibaba. If you have attended my previous webinar, you will know that I am not a believer in Alibaba. Today's webinar won't be about me changing my mind and starting to like Alibaba. No, it's not. So ever since Jack Ma crashed with Chinese regulators in 2020 for criticizing the country's financial regulatory system, my opinion of Alibaba has remained mostly negative. However, there are times when I'm neutral towards Alibaba. Today, I am neutral. So let me give you the Bloomberg consensus view first. 51 analysts recommend buy, 5 recommend hold, and 1 recommend sell. The 12 months target price is 143.24 US dollars. Current price is 93.84, which is upside potential of whooping 52%. I know this may sound like an easy trade to everyone, and probably it is too easy to that really make me worry. But if you believe in this target price and are ready to invest, there are 2 ways you can own Alibaba itself. One, you can buy Alibaba listed on New York Stock Exchange. The ticker code is BABA. 2, you can invest the one listed on Hong Kong Stock Exchange, ticker code 9988. The ones listed on New York Stock Exchange itself is ADR with a conversion rate of 8 shares of 9988 listed on Hong Kong Stock Exchange, which is a common share. But you really do not need to remember this because not a lot of broking houses offer this kind of conversion service. uSMART Securities does not offer it. And if you can find one broking house that do this kind of conversion, the conversion fee is expensive. I think minimally probably $500. So it is simply not worth it. The trading currency for BABA listed on New York Stock Exchange is US dollar, and the one listed on Hong Kong Stock Exchange is Hong Kong dollar itself. The key difference is lot size. The minimum trading unit is 1 share in US and 100 shares per lot in Hong Kong itself. And there is always US delisting risk of Alibaba, but since no one is talking about it now, so I guess Alibaba may not get delisted after all. Nevertheless, one of the most popular China Internet ETF, KWEB, has converted all his Alibaba shares from US listed to Hong Kong listed. So if you are worried about this US delisting risk, probably you should choose the one listed on Hong Kong Stock Exchange. For me, I prefer the one listed in US because BABA has more trading volume, like 5 to 6 times greater. Anyway, the minimum investment amount for Alibaba listed on US exchange is 137 Sing dollar equivalent and about $1,700 Sing dollar for 9988 Hong Kong. So since the minimum investment amount is quite affordable to every one of us, usually it will attract a lot more retail investors to buy Alibaba itself. Comparatively, Tencent, 700 HK, requires a minimum investment amount of about $6,500, 6,500 Sing dollar. This is why Tencent will usually attract more long-term buy and hold investors. Alibaba, on the other hand, will attract more short-term traders or small-time investors. And the low minimum investment amount also explain why Alibaba is usually more volatile and prone to fall harder than Tencent. Okay, let's go back to the fundamental. Alibaba is ranked 55 on Fortune 500 global company list. And Alibaba is also second most valuable brands of China after Tencent. And we may see a lot of investors like Alibaba, but the share price has dropped a lot since 2019. One of the key factors that contributed to the start of this decline was the controversy surrounding Alibaba co-founder Jack Ma. Basically, Jack Ma made a speech in late 2020 where he criticized China's financial system and its regulators as outdated. Shortly after that, Chinese regulator called off the Ant Group IPO and eventually spiraled to crackdowns across different sectors, namely technology, property, and education sectors as well. So it's also during this time that Jack Ma has disappeared from China. So fast forward to today, Jack Ma is now back in China finally. And to be honest, it represents a very big statement that the Chinese government is trying to make to both foreign investors and local entrepreneurs as well. To give you some context, a few weeks ago, Jack Ma was spotted in the countryside. On the first day, he was reported to be back in China. On the very next day, Alibaba announced their intention to split up the company into 6 business units. And I reckon that Jack Ma may have made a deal with the Chinese government before returning to China. It's possible that in January, Jack Ma was asked to relinquish control of Ant Financial. Now the government wants Alibaba, which has become too powerful in China's economy, to be split up in exchange for Jack Ma return to China, and in future less regulatory scrutiny of the company itself. And this is very significant to Chinese investor because this is a big statement that the Chinese government is putting out there that the regulatory crackdown is soon coming to an end. And there are also good reasons to do so because they also want Jack Ma back in China to provide foreign investor assurance that it is safe now to make investment in China. More importantly, the years of crackdown has previously impacted local entrepreneurs badly. Now is the time to show out their confidence that their businesses have the local government support. So to put the jittery entrepreneurs at ease. So now Alibaba has this 6 new business units. But from what I see and understand, it basically is just a change of name from the existing segment to the new segment itself. For example, China Commerce will be called Taobao Tmall Taobao Tmall itself, and this international commerce will be called global digital business group, China is still China. Cloud is still cloud. The only thing that I'm not sure is where does this innovative initiative and others go? Will it be looped into one of the segment here, or will it be renamed as others? In any case, the current person in charge of each existing segment will become the CEO of their respective new segment. So what will happen with the new business unit? Each group will be able to raise outside capital and potentially seeking its own IPO, except for Taobao Tmall Commerce Group itself, which will stay wholly owned by Alibaba. So is this move, the split up, good for Alibaba? The answer would be yes. It's a way to unlock the value for shareholder, and the new individual company is also expected to be more profitable and worth more alone than it would be as part of the larger business entity Alibaba. So, but I would just say that to all of you that please don't get too excited, because the most profitable business, Taobao Tmall Commerce Group, will not go IPO. And the remaining business unit itself, I would say I'm quite skeptical of its success, which I'm going to explain more later. And if you were to look into the announcement itself, it is saying that it is unlocking the value of Alibaba Group various business. But it does not mean that it will help boost the business or the share price of Alibaba Group. So what do I mean by that? For example, if you were to look at China, the Alibaba logistic arm, it has not been profitable because China chose not to be profitable. It mainly served the key customer Alibaba Taobao, which will help Taobao to be profitable by charging cheaper shipping rates, cheaper logistic charge itself. However, once China goes IPO, it will have to answer to its own shareholder, and is likely to start charging Alibaba higher shipping fees to improve its own profitability. So China could benefit as an individual entity in future once it go IPO, but Alibaba Group may not benefit from it. And because of common prosperity and overhanging regulatory crackdown, I will typically apply a China discount to Alibaba itself, which means I do not believe that Alibaba will be able to reach the high valuation which it has had before anytime soon. Like in 2020, you can see that the PE ratio was 40 times to 60 times, and now it's doing 15 times. I don't think Alibaba can go back to 40 times anytime soon, or Alibaba will never ever going to enjoy a PE ratio that is higher than the US technology companies like Amazon or Apple itself. And since there is always an overhanging policy risk that are going to bite Alibaba in the future, this is why I reckon in midterm, state-owned enterprises will outperform private company like Alibaba. So at this moment, I would say that probably it's better to own those state-owned enterprise like those China Telecom or all those company that's supported by the local governments or the state-owned itself. So the immediate question is that, should you buy into the bus? Because it is such a great story for Alibaba's investor now, finally. You could see that there is less regulation scrutiny. Jack Ma is finally back in China. 5 different business units will go IPO, and China economy reopening this year. But I would say that maybe the revenue growth will continue to disappoint, which I'm going to share more with you later. You could see that the share price bottomed in October last year, which is not far away from the all-time low that made Alibaba look attractive at this price level. The technical analysis also looks quite good as well. It looked quite supportive for a rally now that the share price may go up from 93.84 itself, even though yesterday night Alibaba fell by about 6%. And you could also see from the charting itself that probably the investor may be pushing for an inverted head and shoulder pattern, which will be formed after the share price crosses the net line of $118.8, and the potential target price is above $180. But again, it is at best inverted head and shoulder in the making at the moment, because it's basically not yet confirmed. And I also want to show you the Fibonacci retracement as well. You can draw it from the highest back in 2020 to the lowest point last year. Then you can see that it faced some resistance at 23.6%, about $120. Should it cross above $120, then I would say that the next target price will be 38.2%, $157.87 itself. And next, you can also draw a Fibonacci extension from the lowest and to the recent high here at $121, and you could extend it by 61.8%. Then you can get the target price of $160. Lastly, you will notice that the Fibonacci retracement and extension both tell you that $158 to $160 could be the conference zone, that this is quite important resistance level, that I would say that should you previously bought Alibaba at the high and want to get out now, 160 would be a better price. In mid to long term, I would say that Alibaba will still be a trading market, meaning to say it will be volatile. It may drop back to $80 again, then pull up all the way to 120, 140, or even 160. But I would say that it's quite tough for them to create new high in short term or even for long term itself. It will take a long while to go back to the all-time high $320. And to me, I don't really believe in Alibaba long-term prospect. And let me explain to you why. First of all, a lot of investors like Alibaba as they think that Alibaba is a super app. I would say that yes, to a certain extent, but unlike Tencent, Alibaba lacks the communication function in the app itself, that Alibaba does not have WeChat, Weibo. So since Alibaba is not a daily communication application in your smartphone, Alibaba own mini programs will never be as successful as Tencent. So in other words, I would say that Alibaba may not be as successful as Tencent in the future as well, that the market cap will always be lower than Tencent. And let's talk about the business segment one by one. I would like to start with China commerce, which contributing to 68% of Alibaba's total revenue. It's one of the segments that still provide positive EBITDA itself. And China commerce include businesses such as Taobao, Tmall, Taobao Deal, Taocaicai, Alibaba Health, and the wholesale business 1688.com. If you were to look at the revenue, it was 161 billion in 2021 quarter 3. Now is 170 billion in the latest quarter. It is about 5% growth in 2 years' time. In terms of the year-on-year revenue growth is negative 1.3%, and it has been providing negative growth for the past 3 quarters. And the EBITDA margin basically dropped from 44% in 2021 quarter 3 to 35% in the latest quarter. So imagine the best part of the business is giving you a lower profit margin and negative year-on-year growth. This is why I really don't know how should I convince myself to love Alibaba's business model. And I also want to go in depth to talk about the China commerce as well, which includes customer management, direct sales, and China commerce wholesale. Customer management essentially refers to the third-party business, where the third-party seller will list their products on the Alibaba platform and sell them on the platform like Taobao. In return, Alibaba receives commissions and earns the advertising fees to assist all these sellers to promote their products on Alibaba platform. On the other hand, direct sales represents Alibaba first-party business model. So it's called 1P business. So where Alibaba will be purchasing the products from other suppliers, store them at their fulfillment centers, and sell them on Alibaba platform. And if you look closer, the 1P business here is growing 10% year-on-year in the latest quarter, but the third-party business is shrinking by 9% year-on-year. Okay, I would say that I do not like the first-party business model because it has the lowest profit margin, where the third-party business model has the highest profit margin. This explains to you why just now you see a drop in profit margin from 45% 2 years ago to 35% in the latest quarter. And it's very important to grow the third-party business, not only because of the higher profit margin that third-party business give. It's also because third-party business is now contributing to 36.8% of the total revenue. But Alibaba just decided to grow more low profit margin business, which is the 1P business, the first-party business, which I don't reckon this is a good business model. So why there is a 9% year-on-year negative growth in the third-party business? I would say that it's probably due to the intense competition from Pinduoduo, JD.com, Kuaishou, and Douyin that forces Alibaba to provide more subsidy to the third-party seller to sell their products here on the Alibaba platform. The saving grace here is Alibaba still holds the largest market share in China commerce industry, accounting for 50% of the market. In comparison, JD.com holds a 30% market share. Pinduoduo is only 4%. And next, let's talk about the international commerce, which is contributing to about 8% of the total revenue and is still providing the negative EBITDA itself. So international commerce include Lazada, AliExpress, and it has a decent year-on-year revenue growth at about 18% in the latest quarter. And you could see that the EBITDA margin for international commerce should be turning profitable soon. So it looked quite decent, but if you compare it to Shopee by Sea Limited, in the latest quarter, Shopee revenue growth is 44% year-on-year, and the EBITDA is already positive. So Alibaba only has a market share of 14%, Lazada, and the market leader is still Shopee by Sea Limited with 41%. And I would say that I basically don't have high hope on Lazada itself. I would say that I normally buy more things on Shopee than Lazada. So if this international commerce really ever goes IPO, I do not believe that it would be compelling enough for me to invest. And we also want to look at the local consumer service, which include the location-based services such as Ele.me, AMAP itself. And in terms of the food delivery segment, Ele.me has 23% market share. The market leader is still Meituan with 70% market share. The year-on-year growth is 8% in the latest quarter, but Meituan food delivery service revenue growth is 32%. So Ele.me is 8%, Meituan is 32% in the same quarter. So please also bear in mind that it's also rumor that Douyin food delivery will also go online, will go live soon. So the food delivery space is going to get quite crowded soon. Next, Cainiao provides domestic and international one-stop shop logistic services. It is contributing to about 6 to 7% of the total revenue. I'm not able to find the market share, but the logistic business is having intense competition as well. The competitors include Sunfeng Express, JD Logistic, and YTO Express. So all in all, the revenue growth year on year is 26% in the latest quarter. It looks decent again. And it's rumored that Cainiao will go IPO in Hong Kong by end of this year. Lastly, I also like to look at the most promising sector, cloud computing, which is Alibaba Cloud itself. And AliCloud is the market leader in China, holding 37% market share in China, followed by Huawei Cloud with an 18% market share. Tencent Cloud is 16%. But if you were to look into the global cloud provider, Amazon AWS remained the market leader with a 34% market share, followed by Microsoft Azure at 21%, Google Cloud at 11%. In contrast, Alibaba only holds a 5% market share globally. And Alibaba has been struggling, represented by the orange line, to increase the market share in the global cloud computing market itself, because Alibaba holds a 5% market share since 2018 itself and never able to actually break through 5 or 6%. So cloud computing would be considered to be one of the most promising and fast-growing business segment in the technology industry. However, if you were to look at Alibaba Cloud, revenue growth in the latest quarter was only 3% year over year, whereas Amazon, Microsoft, Google Cloud managed to achieve a growth rate of 20% to 30-something%. And Ali Cloud revenue growth also has been declining rapidly from 51% back in 2020 quarter 4 to only 3% year-on-year growth in 2022 quarter 4. Quarter 4 itself. So overall, Ali Cloud is currently considered to be a regional player in Asia, but it has not yet established itself as a global player. Therefore, if you are looking for a top performing cloud provider, Ali Cloud may not be the best choice for you to invest in this cloud industry. And the competition in the cloud industry in China is also quite fierce. Apart from Ali Cloud, there are also other major players such as Huawei Cloud, Tencent Cloud, and even the 3 Chinese communication companies like China Telecom, China Mobile also offer cloud services as well. In 2021, ByteDance also entered the market by launching its own cloud services and stopped using Ali Cloud. And I really don't understand the competitive advantage of Ali Cloud. To me, Ali Cloud only benefit from the first mover advantage. It is not profitable. The growth rate is losing out to other players. So if you are looking for an alternative revenue stream for Alibaba, I don't think you should bet on Ali Cloud. Basically, I just don't see good prospect for Alicow itself. Okay. And here I also want to show you the performance and risk ratio. Here show you the year-on-year return of Alibaba, Tencent, Hang Seng Tech Index, Hang Seng Index, Amazon, Apple. And here show you the annualized return. There are a few key takeaways here. Firstly, Alibaba has been listed since 2014, and Jack Ma resigned as chairman in September 2019. Since the departure of Jack Ma, Alibaba performance has not been as strong as it was before. Particularly in 2021 and 2022, you could see that Alibaba experienced declines of 48% and 25% respectively. And I'm so sorry to say this. I think one of the reasons of the bad performance is because the current CEO and chairman, Daniel Zhang Yong. Jack Ma stepped down as chairman of Alibaba in 2019, and CEO Daniel Zhang Yong has taken up the role. In my opinion, Daniel Zhang Yong is simply not as good as Jack Ma. I think Zhang Yong lacks good execution skill. You could basically see from the lack of revenue growth, which I showed you earlier. The revenue growth is basically slow compared to competitors, which show you that his execution skill is simply not as good. Secondly, if you are interested in investing in a technology company listed in Hong Kong, I believe that Tencent would be the best choice. When we consider the performance over the past 9 years, Tencent has generated an annualized return of 13%, whereas Alibaba, Baba listed on US stock exchange, only generated an annualized return of 2.4%. Thirdly, when it comes to investing in technology stocks, you have a wide variety of choices. You really do not need to limit yourself to just choosing between Alibaba and Tencent. Your option is not binary. You could see that Amazon and Apple has a better 9-year annualized return at 23-24% relative to Baba and Tencent. And you could also see from the maximum drawdown or even the volatility itself that Amazon and Apple simply are simply better than Baba and Tencent. So typically, at the end of my conversation with a client regarding Alibaba, they will always ask me, if not Alibaba, then what? I would say maybe Apple. Apple is one of the best technology companies out there, and investors should really consider owning more Apple shares in the portfolio relative to other tech stocks itself. Okay, that will be all for the of the normal presentation slides itself, and now I move on to the Q&A. Should you have any question, please type it out in the Q&A box, and I will try to answer one by one. Okay, let me look at the questions and okay, it's a good question. So I thought Tencent was also listed in US that you can buy one share. So isn't it going to attract traders to trade more, and hence it's not exactly solely going to attract long-term investor based on your logic? Okay, I guess you are asking because I mentioned that possibly a lot of Alibaba investors are traders, small-time traders, due to low entry fees, which their minimum investment amount is really not a lot. Whereas Tencent Hong Kong investors really need to fork out a lot more money, like 6,000 something, if I remember correctly, to own Tencent. But there is also a Tencent listed on the US OTC market as well, over the counter for investors to trade. The lot size is also one share, and the share price I think is around $40 something last I checked. So I guess it can attract some traders who trade short term. But you need to bear in mind that the Tencent listed on the OTC market naturally has lesser trading volume. Unlike Alibaba, listed on New York Stock Exchange is listed in the normal stock exchange itself. And again, I would say that not a lot of broking houses allow you to trade on the US OTC on Tencent, but uSMART Security here, we allow you to trade on the US OTC. But again, if you were to look at other broking houses, typically they don't open up the OTC access to you. So all in all, let me repeat, volume is significantly lesser for Tencent listed on OTC. Not a lot of broking houses allows investors to trade. So this is why Tencent listed on OTC market is not going to attract a lot of traders to trade them. So to me, Tencent listed on Hong Kong will only attract more long-term investor itself. Okay. Do you think that Adobe is a good buy? Okay, I think Adobe, Photoshop, and Premiere are the dominant players in the graphic design and video editing markets. However, I have not studied enough to make buy or sell call. I think the photo and video editing industry is really highly competitive, and I'm not sure how big the total addressable market is. Typically, I just don't find it very exciting to invest in Adobe. But you could also hear from the news that Adobe recently released a new product called Firefly, which has been okay, decent. It's comparable to Midjourney, which I've been using. From what I see, and been using Midjourney for the past few months, I feel that Midjourney seems to be a superior product, which doesn't surprise me because I use it for quite a long while. Therefore, I don't think you should be expecting too much from Firefly at this stage, because if you were to look at some of the internet comment on Firefly, they are saying that it's really not very good compared to Midjourney. I also have concern on Adobe attempts to acquire Figma. So it has been trying to acquire Figma and also say that the deal will be finalized by year end itself. But the whole deal to me, the acquisition to me, screams monopoly. This is why I am not very optimistic about the Figma acquisitions. So I'm quite neutral on Adobe at the moment. Okay, can you comment on Pinduoduo? Okay, I think Pinduoduo revenue growth is still quite impressive. I have concern about the overseas expansion. I would say that selling China goods to US is a good idea because China products are cheap. But Temu by Pinduoduo is going to burn a lot of money, and the logistic is going to be a problem as well, especially the shipping in US will take about 7 to 15 business days to reach the buyer. So I'm not quite sure if Pinduoduo is willing to spend big money to build the fulfillment center like Amazon. I would say all in all, I like the overseas expansion. The company may stand a good chance in grabbing some overseas market share. Whether now is a good time to invest in Pinduoduo, I would say that maybe Amazon remains a better company with a better business model itself, because Amazon has the largest cloud computing. Okay, McDonald's has gone up to all-time high since your presentation. Okay, is it a good time to invest? Yes, it's a good investment. It's still a good investment. I would say that probably less than 5% of your portfolio. It is still one of the best defensive stocks to me. So all-time high probably doesn't really matter me. It's just that, do you want to own some defensive stock allocation in your portfolio? And I'll say that yes for now. Is Tesla still a buy given that the deliveries number are quite disappointing? Yes, Tesla is still the best electric vehicle stock. Personally, I think much of the hype is already out when they cut the prices itself, so the share price shoot up. And previously, they also conducted the Tesla Investor Day back in March. So personally, I expect some corrections in the share price soon. It's probably best to wait for the share price to drop a little bit to maybe 140, 160 to invest rather than but I would say that probably you should not sell first and buy back later. You should be waiting for a better entry price. Okay, after the talk, late for the talk, will the recording be shared to participants? Yes, the video itself will be uploaded on YouTube tomorrow or the day after tomorrow. So you can search the YouTube. Our channel name is Talk Stocks with James. Okay, can you share your thoughts on TSMC as Warren Buffett has sold off most of it? I think Warren Buffett sold about 90% of TSMC in 1 quarter time, but I'm still quite constructive on TSMC. But I need to admit that this year will not be kind for TSMC shareholder because of the inventory corrections happening in the semiconductor industry itself. So this year will not be a good year. Still, I think that investors should try to accumulate more this year for long-term investment. So I believe that you are asking because Warren Buffett say that he is worried about the geopolitical tension. This is why he sold off TSMC. I think that this is just an excuse. I really do not think that Warren Buffett is so oblivious before he invested in TSMC. I would say that the main reason for Warren Buffett to sell TSMC is probably because he wanted to own more Apple that quarter or the coming quarter. So he wants to accumulate more Apple over the next few quarters, but he already owned about 39%, 40% in the technology sector. So he doesn't want to take too much risk in the technology sector. So this is why he sold off part of the TSMC holding. Again, I reckon Warren Buffett is not a risk-on growth investor. So I will not look much into the decision, his decision on the TSMC investment itself. Okay, I still have some unanswered questions, but we are running out of time. So I will try to answer it in the comment section in my YouTube channel, Talk Stocks with James. And probably I should end here. I should call it a day. Thank you everyone for coming. I hope you well. Happy trading, happy investment, and I will see you soon. Thank you so much.